Welcome to another MBS Highway live monthly webinar. I'm one of your hosts, Megan Anderson, and today we have a very special guest. We have Bob Broeksmit. He's the president and CEO of the MBA, bringing over 35 years of experience in the mortgage sector. He's also a certified mortgage banker and a Yale graduate. Bob has led organizations through all aspects of mortgage banking, from origination to servicing. Now, before MBA, he served as president and COO at Treadliant, offering strategic advisory and litigation support. Bob's leadership has earned numerous awards for excellence, and his insights have made him a trusted source in the industry. And today we're going to explore the latest regulatory updates, including the NAR lawsuit. We're also going to discuss the MBA's market predictions for the coming year. So without further ado, join me in welcoming Bob.
Hey, Bob.
Megan. Hi, thanks for having me. Good to see you all.
Well, we appreciate you being here. That's for sure, Bob. We know you've got a lot on your plate, so thank you very much for joining us. So, listen, there's been some recent developments with the Department of Justice and the NAR. How do you interpret that, and how do you think that affects us in the mortgage industry?
Yeah, well, I think, Barry, it's been really interesting because the concern that a lot of people had as the DOJ took its time, I think they took to the day before the deadline to register its views on this, was that they may not have been satisfied with the settlement that continues to permit cooperative compensation, meaning that the seller can pay the listing agent and the buyer's agent as well. And as you know, and our viewers know, that continues to be permitted, just can't be done on the MLS itself. So some thought that the DOJ would think that didn't go far enough. But interestingly, it appears that the nature of their objection is requiring the buyers to sign a buyer agency agreement, and they're concerned that that could stifle competition. And if you really look at what DOJ did, and you have to remember this is a lame duck DOJ, so what really happens after January 20th is open to interpretation. But what the Biden DOJ did is make clear that following the settlement does not absolve the defendants from future antitrust actions. I thought that was really the headline.
Got it. Okay. Well, I understand that things may change, but the way it is right now, what I've noticed, and I think what a lot of mortgage professionals have noticed, that many real estate agents are just doing business as usual. They haven't really made any changes. Do you think that that's something that that's a mistake for them, that they should be changing? And also, we know that the cooperative compensation agreement could still be done, just not, I don't know, for lack of a better word, just not overtly, where it's on the MLS, has to be more behind the scenes, where they're not coming out and blatantly advertising it, which I never understood that kind of distinction. Either you should be able to do it or shouldn't. Do you think that ultimately that there will be an allowance for that? Or how do you think this shakes out, Bob, especially contemplating what happens now with a new administration?
Sure. Well, there are a couple of schools of thought on this, and one of them is that this whole thing for how real estate transactions are handled in this country is a little like Y2K, where there's all this buildup and angst and money spent trying to prepare, and then life goes on as if there hadn't been a change. I don't quite subscribe to that, because you do see that there appears to be some softening in the commissions being paid. I saw a report recently that suggested maybe 30 basis points or so, from like 2.7 to 2.4 or something like that, in terms of percentage paid to the buyer's agent. And you're certainly hearing anecdotally that there are some buyers who are foregoing the agent, thinking either that they don't want to pay for it. And it is a weird process, right? Where when you sign an agreement to see a house, you say how much you will pay the buyer's agent, even if later you write an offer and say, okay, well, really the seller's got to pay the buyer's agent. But it highlights the expense, and it leads some buyers to say, gee, if I weren't paying $10,000, $15,000, $20,000 to the buyer's agent, I could put in a more attractive offer, et cetera. So you do see some around the margins behavior change. And of course, a lot depends on the sophistication of the buyer and the condition of the market. But I do think you have some buyers who say, look, this is not my first house I'm buying. I kind of know the process. I've gone online and found the house I want, or I'm buying the one down the block that I've always had my eye on and finally came on the market. And so I do think you'll see some changes, but generally speaking, it seems as though the sellers continue to pay the buyer's agent, and there's been only a modest reduction in the total commission. But these are early days. After all, the settlement got the final approval by the judge just last week.
Yeah, yeah. Well, thank you, Bob, and thank you for giving us some great insight there. I also wanted to ask you, is there anything that you see ahead that maybe we should have on our radar? Are there any potential regulatory changes or things that you're working on to try and protect the industry about, or that we should be aware of, that we may not be in the forefront of our mind right now, but they're things that you're could be concerned about, or things that we should be thinking about?
Sure. Well, of course, the election is fresh on everyone's mind. And with a Republican sweep, albeit by the narrowest of margins in the House, I think there's still one race in California, believe it or not, that hasn't been called. And there are 220 Republican seats. You need 218 for a majority. And President Trump has already indicated that he's going to nominate some sitting Republican Congress people to positions in his administration, which is going to be really tricky to have a governing majority. And what I mean by that is, if you have anybody out sick, death in the family, some conflict that they can't get to Washington for, you don't know day to day whether you have the majority. And the special elections that it takes to fill the seats of the people who will join the Trump administration, or people like Matt Gaetz, who is not going to join the Trump, at least not as Attorney General, but is resigning from the Congress. They vary by state, and it's going to be a really difficult job for Speaker Johnson to know whether he has a majority. But anyway, having said all that, I know that's a little inside baseball from my perch inside the Beltway. But they do, of course, have majorities in the House and Senate, and they have the White House. And that means that the priorities from a regulatory standpoint, which affects every loan officer in this country, I mean, I know many would say, I don't want to deal with that, but it's a sad truth of our industry that you do have to be concerned about it. So on the positive side, I would say, is that you're going to get from the prudential regulators, the FDIC, the OCC, and the Fed, you're going to get different people in charge of supervision. At the Fed, Michael Barr will stay on for a little while, but at the OCC and the FDIC, you'll get new people in on day one, on January 20th. And the zeal with which they pursue regulatory and enforcement actions in a Trump administration is almost certain to be less than it was in a Biden administration. Similarly, at the CFPB, Director Chopra will be out day one on January 20th, unless he leaves before. My sense is he won't. He'll probably be there until the pink slip arrives at noon on the 20th. And certainly you'll see a much different focus from the Bureau, and really looking at things that harm consumers, as opposed to trying to expand their authority into everything that every financial service provider does. And perhaps most importantly, if you look on the administrative side, it's pretty clear that a Trump administration would be much more willing to pursue a release from conservatorship of the GSEs. And so what does that mean if you're a loan officer? Well, Fannie Mae and Freddie Mac, operating within conservatorship, have a pretty broad scope of their mission. And they do a very high percentage of the loans in this country. And they do some things that some with a more conservative view of what the GSE should do think they shouldn't do. Think investor properties, multiple investor properties to the same borrower. I would expect that would be something that would be on the agenda for the new FHFA director. Second homes, you've already seen them price them a good deal higher, and there may be continued pressure on whether the government should be backing second homes. And you will also see the jumbo conforming. It doesn't help people who support the GSEs when the loan limits get published. And granted, they're just following the statute, but you can get an awfully big mortgage for a high balance conforming in a lot of different counties around this country. And it makes for good headlines to say, why is the government involved in this kind of lending? So those are the things that I think people should think about when they consider whether the Trump administration will pursue an exit to conservatorship and a shrinking of the footprint of Fannie Mae and Freddie Mac.
Do you think it's a good thing that the government exits conservatorship?
It's a really good question, Barry, and it's a straightforward one, which I won't give you a straightforward answer to. And the reason I won't is because if you think about it strictly, purely academically, a conservatorship is meant to be a timeout. It was 16 years ago. Somebody said, well, geez, I gave timeouts to my 2-year-old. My 2-year-old's now 18, and the Fannie and Freddie are still in conservatorship. So it's not how it was supposed to work. And so from a purist view, you would say, gee, well, let's fix that. The structure is not how it should be. These companies should be outside of government control. But then, of course, the devil's in the detail. And if you do it wrong, which we worry about, then they'd be better off staying in than going out. And if they do it right, you've got to get Congress to agree to put an explicit guarantee on the securities of Fannie and Freddie. That hasn't happened in 16 years. There's plenty of opposition to that. And we think absent a guarantee, they're probably better off in than out. And there's all kinds of things that could go wrong and increase the cost of mortgage financing in this country if they are released from conservatorship and it's not done right. And at a time when housing affordability is at its worst and was a significant issue in the campaign, unlike anything I've seen in my adult lifetime, I think it would be foolhardy to rush an exit that risks having rates and mortgage payments go even higher. I think it would be a political disaster, among other things.
Well, no, actually, I think you did a great job of answering the question, Bob. And we all, by the way, truly appreciate the great work that you guys do, and you in particular, but also another great member on your team, Mike Frantantoni, who does terrific work. And some of the things that you had mentioned, housing affordability, as well as interest rates. I know Mike has done some great work on that. And I don't know if you could share any of his thoughts on what he thinks as far as on the housing front, home prices, as well as home activity, the two different things. What does he think that 2025 holds in store for us from those two sides of the housing market?
Well, Mike is seeing what we're seeing in the data, which is that the inventory is gradually inching up, so that we're at about 4 months where we had been as low as 1.7 or something. So I do think you're seeing what we all expected, which is that while a lot of people have 3% and below mortgages and are effectively locked into their houses, every month, every quarter, every year that goes by, there are more who are capitulating and saying, you know what, we had that second kid and this house is not big enough. Or, I got a raise at work. I can afford, I don't want to give up my 3% mortgage and get a 6-point-something% mortgage, but I'm going to do it because life goes on and you just can't pick your spots for all of this. And the other point, of course, is that builders are seeking to fill the void, and a much higher percentage of the inventory now is new construction versus existing homes. So all that to say that we do expect the cyclical lows of the fourth and first quarter to persist. As you know, home buying is certainly a more of a second and third quarter endeavor, but that we do expect a decent rebound in 2025 in terms of total volume. Now, we have had to scale back the size of the rebound a little bit with the pre and post election run up in the 10-year treasury and then correspondingly in the 30-year fixed. But we've seen some relief on that just in the past few trading days. So there's hope that, obviously, to put a fine point on it, the bond market liked Scott Bessent for treasury as opposed to some of the other people who were being rumored. Maybe a little bit less worry about instantaneous, large-scale, widespread tariffs, which would have been inflationary. And Besant has indicated concern about the fiscal state of our country, which is important because it's crazy to run $1.8 trillion deficits at peacetime when your economy is growing. That's like a wartime recession kind of deficit. So anyway, the market is feeling a little bit better about that. We'll see as the confirmation process ensues, although I expect he'll have no problem. So anyway, all that to say that that we do expect a decent rebound in 2025, and it will be better than decent if we get a little bit more relief on these rates.
It seemed like we got to about a 6% level, or especially when we cracked 6% in rates. And we had a couple of quick views on that back in the first week in August, when, I think it was August 5th, we got the employment report, which showed the unemployment rate making a surprising move higher for the cycle high. And we got a brief period of time. And then again, mid-September, leading into the Fed meeting, we saw rates drop. And then, again, we got zonked by a jobs number that, it was a little bit unusual. I'm just going to put it that way to be kind, with some of the numbers that we saw, the generous seasonal adjustments that were done. But that seemed to scare interest rates higher. And then, as you mentioned, the fear, I don't know if the fear is the right way. Bond market didn't necessarily love the fact that Trump was then leading and then eventually got elected. The risk on assets clearly loved it. We've seen the stock market and things like Bitcoin do extraordinarily well. But a lot of it's centered around what you mentioned, which is tariffs. And I think now maybe the bond market is coming to the realization that, you have to play chess and not checkers, in that you could talk tariffs, doesn't mean you're going to have tariffs. And as a result of talking to them, you've already seen Trudeau fly into Mar-a-Lago. Then you've already seen, Mexico talk about tightening its borders. So I think that it's had the desired effect. I don't think the media quite understood how negotiations work, but I guess I'm a little bit more optimistic on seeing, the fears that the bond market had maybe not come to fruition. But also, I think when we see the job numbers, especially on Friday, this week is a big week, but some of those generous seasonal adjustments, they have to run out. You have to true up the numbers. And I'm sure that you guys saw the numbers that came out of the QCW, where it essentially said that half, pretty much almost a little bit less than half of the jobs that were initially reported and then revised lower. So from the revision, so you got whatever the job number was, then it was revised. And then from that number, there was actually less than half of the numbers through June of 2024 that were actually reported. I think that when we see what happens with the seasonal adjustments, there's a chance that we might get some more cooperative numbers in the job reports. Do you think that if we get rates around that 6% level from these things that might happen, we could potentially see a reasonably large increase in home buying activity?
I do. I think that anything with a 5 handle on it, even if it has a 99 after it, really will stimulate things. And we've been surprised, as you know, we put out our weekly application survey. We've been surprised by how sensitive the home sale numbers are to reasonably modest changes in week-to-week interest rates. So I think there are a lot of people that are following this. And I do think that there are people who have in their head, if it's got a 5 handle on it, historically, that's a pretty darn good interest rate. It's just that it's not as good as the best ever, which we had during the pandemic. So, and of course, it also helps with affordability. And you've seen builders, to state the obvious, fund buy downs to get their buyers down into that range. And I think it's been very effective. And one other thing I want to mention as you think about bond market sentiment, I've talked about tariffs. The other really important thing, and this ties in with the fiscal picture, is the tax debate. So this will be front and center in 2025 because, as you know, the Trump tax cuts expire December 31st. And the size of the package is going to be really important to the bond market. So you know the game in Washington. There is the Congressional Budget Office. There's the Office of Management and Budget. They have different ways of counting and scoring various tax and revenue proposals. And there has historically, although not as much recently, been a desire among fiscally prudent Republicans to pay for things like tax cuts, right? So if you say, all right, well, the tax cut's going to cost me $1 trillion, it'll be much more than that, but just to throw out a round number, then I want to show $1 trillion in spending cuts or other offsets. And so there's this whole debate about how much credit do you give for the growing economy that will result from lower taxes, so that while the rate of taxes may be lower, the dollars are higher, so you're actually staying even or making up ground. Then you'll have other people criticize that for saying, oh, that's continuously overestimated. But anyway, the point is simply that if the Republicans seek to, through reconciliation, which they can do in the Senate with only 50 votes, to have a big blowout of a tax plan with no fiscal cuts, call it $7 trillion, I think the bond market will view that very unfavorably. If they can be a little more disciplined and be convincing about the offsetting revenues and make some of the cuts to federal spending that have been discussed. And, you know, tariffs are a double-edged sword, but I guess they do provide some revenue, and you could count some of the tariff revenue. But if there's a disciplined approach there, then I think the bond market will like that better. And I'll throw in one more kernel in the tax debate, which is that the state and local tax deduction, the SALT deduction, is a big political issue in states where some of the races that determine the control of the House were made, including New York and California. And generally you'd say, well, the Trump administration doesn't care about big blue states that are they view not run very efficiently, and why should the other states subsidize the taxes that citizens pay in those high tax states? The fact is that with such a small House majority, the SALT coalition could be New York, New Jersey, California. I live in Maryland. I'd certainly benefit from
Illinois is another big one.
Yeah, exactly. Restitution of, you know, getting above this $10,000 cap. So my point is simply that that's going to be in play too. And when you think about the campaign ideas that Trump floated, including no tax on tips, no tax on overtime, no tax on Social Security earnings, giving you tax deduction for the interest on your car loan. And then he threw in SALT when he was campaigning in New York. There's going to have to be some real discipline among the Republicans in what they come forward with, both from a practical perspective to get it passed, but also so that it's not viewed as a big spending blowout, deficit blowout that will increase the issuance of Treasury debt and therefore make it more expensive, which is what the people listening today care about. What's the 10-year Treasury? What's the spread over that to the 30-year fixed? And can I make some mortgages in 2025?
That's such great insight, Bob. So, you know, interesting when we talk about those things. We know a couple of things about the scoring that we get from the Congressional Budget Office. They're not allowed to try and forecast recessions. Then if one occurs, that could definitely make the deficit much larger, right? So that's one aspect of it. And then the other that you talk about is, you know, if we do have all of these things that are now, you know, this candy that's given out, or perhaps it's all for good reason, whatever it is, and there could be really good arguments for all of it. There is certain things on the spending side that can potentially be done. And I'm glad we have now the DOGE. I'm glad we have the government efficiency. I get that. It's not an easy task, but you've got good people, hopefully, that can do some good things there. But I believe that 86% of our spending is compensatory, mandatory, based upon entitlements. And I don't know if you make any real big headway unless there's a willingness to touch that third rail of those, you know, entitlement spends that, listen, you know, they're all important, But Bob, I also think that if we don't do anything about making changes to Social Security, a short 6 or 7 years from now, might be six now as we come up to 2025, that there's a mandatory 23% reduction in Social Security benefits. So I think probably for the next election, certainly to be the centerpiece. But do you think that anything really meaningfully can be done with those things today?
Well, you're right that Doge, Musk, and Ramaswamy are looking at a very small sliver of the federal budget. When you count interest on the debt, which now exceeds what we spend on our defense, and you take away defense, and I'm not saying there aren't some things that you could do in defense to make it more efficient. So I hope they take a look at that. Frankly, I don't want our defense to be compromised, but it's an awfully big budget and they could probably find some savings there as well. But generally speaking, they're talking about non-discretionary spending. So not Social Security, not Medicare, not Medicaid. Interest on the debt is non-negotiable because we're not going to default, I hope. You want to see interest rates go up, try a sovereign default. So yeah, it leaves them with somewhere in the teens. I think it's 16% or something like that of the federal budget. And the heads of the unions that federal employees belong to are quick to point out that that includes things like meat inspectors to make sure that we're not poisoned when we eat a hamburger, and all sorts of essential services that nobody in their right mind would say we got to get rid of that. Now, that doesn't mean there's not some to cut, but you're talking they're talking 2 trillion. I'd be doing somersaults if they got 300 billion, right? I mean, that's a lot of money, but when you're talking about trying to offset tax cuts in the multiple trillions, it's really apples and oranges. So I'm glad that the effort will be pursued. As you rightly say, some of these things require 60 votes in the Senate, like if they wanted to get rid of the Department of Education, which, frankly, Jimmy Carter started it. It was not something that goes back to the founding of the country. And you could make an argument about whether it needs to stay in place or not. And if it doesn't, do some of its functions need to be moved to other departments, which would reduce the savings? But anyway, there is not an easy or painless or politically palatable way to get rid of trillions of dollars in spending, because you'll hear howls from all corners of the country for people who, they might like to rail against government spending and deficits, but take away something that helps them in their daily lives, and that's not going to go over well.
Yeah, not in my backyard, right?
Yeah.
It's like so. Is it the I guess unless you hit a point of crisis, it's hard to make those things. I mean, what's happened in Argentina is being hailed now as the Mille miracle, right? So, we hope we don't get to a situation like that here, and that there could be some progress made to avert that. But it seems when you do reach that crisis point, when it gets to be too much, then there's nothing left but bad choices or tough choices that they have to be made. Sometimes that's what it takes to make progress. I obviously hope we don't get there. I wanted to kind of see if there was questions from some of our, we've got 650 wonderful subscribers here, Bob, that are loving what you're saying. They're first of all so appreciative of you taking your valuable time. I'm just looking. Somebody explain.
We have one here from Phil. The November MBA mortgage finance forecast predicts that through 2027, the 30-year fixed rates will not go below 6.3%. Why do you think that is?
That's a recent update. We had been in the high fives, like 5.9, and I do think it's a direct result of the bond market's initial reaction to a Trump presidency and some of the policies it thought he would carry out. We update that monthly, so we're not going to do a special one to, obviously we can't be chasing the bond market every week, but I do think, as I mentioned earlier in the broadcast, that if Scott Bessent is the Treasury Secretary and he is a moderating force in terms of tariffs and somebody who is concerned about the ever-ballooning federal deficit, I think the bond market will appreciate that and will the 10-year will drop. And I also, as Barry knows probably better than anybody, the spread between the 10-year Treasury and the 30-year fixed is a really key number for our industry. That still has room to come in. If there's some reassurance that there'll be some fiscal discipline, I think that spread will come in. I think when Mike made his latest forecast, there was no talk of fiscal responsibility, frankly, from either party. And the potential for tariffs on day one and just a really bloated need to issue treasury bonds influenced his projections. But stay tuned. We do modify them monthly. Sometimes they stay virtually the same, but when the market's been active and there's a lot happening politically and fiscally, we certainly can adjust them month to month.
Yeah, and I listen, I think Mike does always such a great job, and I can completely understand his rationale for those forecasts at the time. And it's just kind of like John Maynard Keynes said, when the facts change, I say change, sir. Like, what do you do? So as different facts come in, things can change. And some of those facts will be obviously the job market, but in response to that, what will the Fed do? So we know that we've got a very big employment report coming up. We'll have a CPI report, which of course the Fed looks at, but I think the Fed is getting smarter. They're certainly citing that they're more cognizant of the lags on the shelter component, which is especially a heavyweight in CPI, and less so, but still, a close second to healthcare in the PCE report. So we do some calculations on these things, and what we've discovered is that if it were to be a more real-time reading in the shelter component and contemplating the lag, that we'd be more like a 2.1 or 2.2% year over year on those inflation readings, which would give the Fed comfort and the bond market comfort. So I think that those are pluses for us. Clearly, we've outlined some of the things that could go wrong, and especially the debt could be one that has the bond market having some heartburn. But then comes the Fed, and so on December 18th, I think that the Fed is in a tough spot, because I think they will cut another 25 basis points. I think they feel that they're still restrictive, so they have the room to do so. And I think that they're concerned about the labor market, because it's certainly not as strong as some of those early reports would indicate. I think it'll shake out to the labor market is obviously not in horrible shape, but not in as strong condition as some of the numbers would be telling us in the past. However, the 3-month run rate on inflation has moved up quite a bit, and I know the Fed knows that. So, what do you think the Fed's outlook will be in 2025? And then if the Fed continues to cut, does that eventually, in your opinion, filter through to the longer maturities, as some people will say, hey, look, let's term out of those short-term things like money markets, which have been a very, very nice place to hide. But if we think that we're going to see continuation there, do we then take advantage of some juicier yields long term? How are you thinking about those factors from the Fed to how it affects the longer end of the yield curve, if you think the Fed's going to continue to cut?
Yeah, it's interesting. We had Mohammed El-Arian at our convention in Denver in October, and while I wouldn't presume to advise Jay Powell on how to run the Fed, he can. And he said that he thought that the Fed, while he understands being data dependent, it ought to have a thesis, and they ought to stick to the thesis and not change or reconsider every time there is an aberrant reading, the way there was on the jobs report that you cited. And so his view is that we're too restrictive. You take out the housing component and we're already at 2%, or take it out, or as you say, normalize it, get rid of some of the lag. I mean, we have a big multifamily and commercial arm of the MBA, and all of the practitioners there tell me that rent increases are 0 to down in a lot of cities. Now, not everywhere, but a lot of cities that had driven increases are now showing drops. But because of the lags in that measure, they're not coming through, but they're very predictable because all you got to do is look at real-time measures of what are the incentives for new leases and what are the rents year over year in cities like Nashville and Tampa and Phoenix and Texas cities, various others. And you'll be reassured that that's not going to be a catalyst for increased inflation. So our hope is that the Fed will take a long view and continue methodically cutting, not quickly, but methodically, with 25 basis points in December, and then 3 or 4 further cuts spread throughout 2025. And that you'll see a steepening of the yield curve, which will encourage people to go out to that longer end. And all that will bode well for mortgage rates, both in terms of where the 10-year goes, and then what the spread is. We still think that spread has room to come in, so that even if the 10-year doesn't drop further, which we think it will, but even if it doesn't, you could see 30-year rates come in. So anyway, that's a long way of saying that we don't think that if there's a strong employment report that the Fed ought to say, okay, well, that changes our entire course. We think that there's a lot of noise in those reports. You can go into which sectors are adding the jobs, service versus manufacturing and goods, and government versus non-government. You could parse the figures 10 ways to Sunday, but I think everyone agrees with what you said, that the job market is not bad, but it's certainly not as strong as it was. And at the level where interest rates are today, it's restrictive, and they can come down without significant risk of overshooting and having inflation rear its ugly head again.
Well, so first off, Bob, it's very obvious you've got such a great command of not only what's going on regulatorily, but overall economically, and how it all intertwines and affects us. So we want you to know that we appreciate that very much. I want to just rewind back with one more question for me, and then I'll turn it back over to Megan and Dan to see if they want to highlight some things before we close from some of the questions that I'm seeing pile up in the chat, or if they have a question for you. But I want to just go back just for a minute to housing itself and the way that we could look at housing. I know one of the things you mentioned was the month supply, that, if I look back over the last 30 years or so, 4.6 seems to be about an average, and we're a little over 4, as you correctly stated. But, as we know, that's such a volatile number because it's sales pace and inventory. And also we talk about things nationally, but we all know real estate's very regional. The inventory situation, which is, of course, the component that tells you how much supply is out there. While we do see an increase in inventory, and people talk about that, we're still significantly below levels that we had pre-COVID, rather significantly, in the range of 27% or so below that, even with this increase. And the increase in inventory has been focused or more concentrated in areas like Texas and Florida. So we haven't seen like widespread inventory. So given that, and given the rate environment, there's been so many naysayers on housing for a long time, Bob. And, Mike's been right on housing. I think that we've done a good job on housing and forecasting it. And we've been kind of on islands almost in trying to explain that we still think home values have positive growth overall. We still feel that way. How do you look at it? How does the MBA look at it, or Mike look at it, as far as home price appreciation?
Yeah, we generally think that if the job market is okay, then mortgage delinquencies will be low. There's a really close correlation between the unemployment rate and the delinquency rate on mortgages. And when delinquency rates are in hand, there's generally more demand for housing, because people aren't reading headlines and saying, gee, why would I want to buy a house if I'm going to lose the house? So I think that the demographic figures that Mike always points to, with the number of people entering prime home buying age, granting that prime home buying age is a little older than it used to be. People are getting married later, they're buying a house later, but they still are forming households and want to own. There's some concern about whether they can afford to own, but they want to own. And that's a really crucial piece, and one that MBA cares greatly about, because we've been around 106 years and we want to be around another 106, and we want generations to want to continue to be homeowners. So one thing that we are a proponent of, and it may come up in this tax debate in 2025, and I'd encourage everyone listening to be involved in this, is that one way to free up inventory is to give a tax incentive to people who have a lot of equity. We're at record levels of home equity in this country. And I'm sure we all know people who are rattling around as empty nesters in big houses, who are sitting on more in capital gains than the exclusion permits, which is $250,000 for an individual and $500,000 for a married couple. And if you were to either say double the amount, there's a bipartisan bill in the House that won't go anywhere in the lame duck, but it'll be picked up next time, that would double that to $500,000 for an individual and $1 million for a married couple, and index it to inflation, because it hasn't moved up for, I forget, 20 some years. And there's another idea of a holiday, of a capital gains holiday, to get some of this inventory onto the market. And somebody might say, well, gee, it's not at the $1 million home level where we're lacking inventory. But as everybody who knows real estate understands, somebody buys the $1 million house, that person sells a house, and it goes all the way down. And what we need is more supply at every level. So I think that is a practical and would be viewed as a fair way by Americans who say, geez, this person has been in the house for 30, 40 years. They'd be happy to move into something smaller, or a retirement community, or their second home, or whatever it is. And they're kind of stuck, because if they wait, this sounds morbid, but if they wait until they die, the heirs get a step-up basis and they don't pay any tax. So let's meet in the middle and let them move on. Let's get that house into maybe a younger family, and let's get some more inventory. I think it's a really attractive proposal.
I think that's a very, very good idea, Bob. It's excellent. Megan and Dan, just want to turn it over to you here before we close out.
Yeah, I will say that last answer, you did get a lot of love from everyone here watching this. I do have a couple questions. One, in the chat box, it was kind of brought up about your outlook on a potential recession. Do you see that happening? And if so, when?
Well, I'll have a preface saying that I'm not an economist, and this is best put to Fred and Tony, but no, I don't. I don't know what would cause one. The employment picture continues to be very strong. We talk about, those of us who have a few years on us, when you look at today's unemployment rate, you'd say, gee, that is below the point at which the economy was considered at full employment when we were being taught about such economic terms, right? I mean, I remember 5 or 5.5 was considered full employment. So we obsess over those numbers, and maybe that's an occupational hazard, but it's still very strong. And the other thing is, look at any other country in the world. Any other country in the world would want to have the economy we have, warts and all. So I don't see what would be the catalyst for a recession. And I know that in the mortgage business, a recession comes with lower interest rates. So you'll never hear me wishing for one, but I know that there are people in the industry who are like, well, I don't know, that'd be kind of good for my business. But I don't see the economic fundamentals that indicate that a recession is on the horizon.
And I have one more question, just to kind of recap everything that we discussed today, from, the MBA's outlook into 2025 and future regulations coming to the industry. If you were to just kind of give some words of wisdom, your leadership, to everyone here today, what are some ways that they could, move forward as far as everything that is coming?
Well, I would say play the long game. And I know that being a loan officer or working in the transactional side of our industry tends to be a short-term horizon, and when's the next application and when's the next closing. None of those happen if we don't have our eye on the longer term, and that's where MBA can come in and be really helpful. So I would just encourage you. I know this will sound like I'm promoting myself and my organization, which of course I am, but I actually believe it, that you need to be involved, your company needs to be involved, you individually need to be involved, understand these issues, and weigh in with your elected representatives. And you're going to say, well, geez, I'm just one person. They don't care what I think. You know what really has surprised me in my time in Washington is that when we go to Capitol Hill and we meet with a senator or a representative, and it's just the hired help, like Bill Kilmer and the lobbying team and me and whoever else, we get a cordial reception. And of course, we've probably given them a PAC check at some point along the way. But when we bring practitioners, all of the attention of the elected representative goes to the person who lives in their district or their state, employs people in their area, brings economic development to that area, knows the area, talk about where they went to school or who they know in common. And boy, do they really listen up. And another thing that people don't tend to remember is that your representatives in Congress are home much more than they're in Washington. When they're in town, it's generally a Tuesday through Thursday session. They're on recess a lot. And when they are, they're in your home district and they have district offices. They are less pressed for time than when they're in Washington and some aide is saying, sir or madam, we have a vote. And you can actually sit down with them and have them understand your company and your concerns. And you wouldn't believe the influence you can have. So the Mortgage Action Alliance is one way to do that. MAA, look up MBA.org and look up Mortgage Action Alliance, get involved. And our staff would be happy to help you if you want to get involved in setting up an appointment with your representative. It really matters to the long-term health of your business and to our industry.
Well, I can't thank you enough on behalf of MBS Highway subscribers. We definitely should be as supportive as possible of the MBA. Bob, you have done such a great job as leader. You continue to do a great job. We appreciate you. We know that the future of our industry is in really good hands with you and your team there. So God bless you and thank you so much, Bob. Thank you for sharing time with us here today. We hope we can have you back. It's been very meaningful.
I'm delighted to do it, Barry, and happy holidays to everybody too.